3 years. That's all it took in 1929 to erase a generation of wealth. But while millions were destroyed, a small group didn't lose anything at all. In 1929, the stock market crashed. Over the next 3 years, American GDP fell 30%. Unemployment hit 25%. 9,000 banks failed. 13 million people lost their jobs. Life savings evaporated. Families starved. The middle class was destroyed. But in 1933, when Franklin Roosevelt took office and started investigating who profited from the crash, he found something disturbing. The same bankers who caused the collapse, who lent recklessly, who manipulated markets, who told the public everything was fine while they were selling, those bankers didn't lose money. They made fortunes. Joseph Kennedy, who'd later become ambassador and patriarch of the Kennedy dynasty, made $4 million shorting the market. That's $100 million in today's money. The Rockefellers bought assets at pennies on the dollar. JP. Morgan's wealth doubled between 1929 and 1935, while everyone else lost everything. This wasn't luck. This was positioning. A survival mechanism that financial elites have used through every economic collapse for 3 centuries. And the mechanism is still operating today. The same institutions, the same structural advantages, the same sequential positioning. Let me show you how financial elites don't just survive economic collapse. They position before the crisis, access resources unavailable to others during chaos, and consolidate wealth while everyone else loses everything. This is the pattern across 7 major collapses. The same 6-stage sequence every single time. South Sea Bubble 1720, Panic of 1837, Panic of 1873, Great Depression 1929, Latin American Debt Crisis 1982, 2008 Financial Crisis, and the conditions forming now? 7 collapses, 7 times. The elites survived and profited, not because they're smarter, because they control the mechanisms. Before we go through the historical examples, you need to understand what economic collapse actually looks like for the 2 groups. For regular people, collapse means job loss, foreclosures, savings wiped out, retirement destroyed, assets they own, their house, their stocks, lose value faster than they can sell. Debts they owe stay the same or get worse. They're forced to sell at the bottom to survive. They lose everything and never recover. For financial elites, collapse means buying opportunity. Assets are cheap. Competitors are bankrupt. Workers are desperate. Credit is available at central banks. They buy assets at 20, 30, 50% of pre-crash prices. They hire talent for half the cost. They consolidate industries. And when recovery comes, they own everything. The difference isn't skill, it's access to information, access to capital, and a control of the timing. The South Sea Bubble, 1720. This is the original template. England had just fought expensive wars. The government owed massive debts. A company called the South Sea Company offered to take over the government's debt in exchange for a monopoly on trade with South America. The stock price started rising. The company spread rumors of vast wealth in South America, gold, silver, unlimited riches. The stock went from $100 to $1,000 in 6 months. Everyone bought. Nobles, merchants, clergy, even Isaac Newton bought shares. The frenzy was total, but the South Sea Company had no real trade. The profits were imaginary. The stock price was speculation built on speculation, and the insiders held the information advantage. Stage 1. Create the bubble through credit expansion and promotion. The South Sea Company directors borrowed money to buy their own stock, inflating the price. They lent money to investors to buy more stock. They published exaggerated profit reports. They bribed politicians and newspapers. The bubble grew because the structure incentivized expansion. Each price increase justified more lending. Each new investor created demand for more credit, and while they were promoting the stock publicly, they were repositioning privately. Stage 2. Convert inflated assets before the collapse. In April 1720, when the stock hit $900, the directors started selling, quietly, small amounts. They converted stock into gold and land, assets that couldn't collapse. By June, the stock hit $1,000. The public was still buying. The insiders were still selling. In August, the stock started falling. $800, then $600, then $400. By September, it collapsed to $150. By December, back to $100. The insiders were already out. They'd converted inflated stock into real wealth, gold, land, foreign assets. The public was destroyed, life savings gone, families bankrupted. Some committed suicide. Parliament investigated. They found that the directors had sold $10 million in stock at peak prices while telling everyone to keep buying. That's $3 billion today. One director, John Blunt, had turned his shares into land worth $700,000. He lost some in the investigation, but kept most. He died wealthy. Another director, Robert Knight, fled to France with his fortune. Never prosecuted. The pattern was established. Insiders with access to company information and credit markets create conditions for asset inflation. They convert those assets before collapse. The crash happens. Public destroyed. Insiders survive. Wealthy. What matters is the sequence, not the intent. The structure created the opportunity. Those positioned to exploit it did. Jump forward 117 years. America, 1837. The mechanism evolved, but the pattern persisted. Andrew Jackson had just destroyed the second bank of the United States because he believed it concentrated too much power in elite hands. Without a central bank, state banks began issuing paper currency backed by almost nothing. Credit exploded. Land speculation went insane. People borrowed to buy land in the West, assuming prices would keep rising. It was a bubble, built on debt, built on speculation. And the elite bankers in New York and Philadelphia, with access to British capital markets and information about European credit conditions, saw the fragility clearly. Stage 1, bubble inflates through reckless lending. State banks issued currency printed on demand. If you wanted to borrow $10,000 to buy land, banks printed the money and lent it to you. The money supply increased by 40% between 1834 and 1836. Prices rose. Land doubled in value. Everyone thought they were getting rich. But the banking elite, with connections to British financial houses, knew the bubble was unsustainable. By 1836, the British banks that financed American credit began pulling back. They demanded payment in gold, not paper. American banks didn't have enough gold. Stage 2, position before the crash. Nicholas Biddle, former president of the second bank, saw the credit contraction coming. He converted his bank's paper assets into gold and British securities. He moved wealth out of speculation and into safety. The Astor family, real estate magnates with European banking relationships, stopped buying land in 1836 and started accumulating cash. In May 1837, New York banks suspended gold payments. They couldn't meet withdrawals. Panic spread. Banks across America failed. Over 600 banks went under. The money supply contracted by 30%. Credit disappeared. Land prices collapsed. Businesses failed. Unemployment exploded. It lasted 7 years. Regular people lost everything. Farmers who'd borrowed to buy land lost the land when they couldn't repay. Workers lost jobs. Savings evaporated because the banks holding them failed. But the elites who'd repositioned, they survived. And they bought assets at the bottom. The Astors bought land in Manhattan at 40% of pre-crash prices. Biddle's group bought state bonds at massive discounts. By 1844, when recovery began, they owned more wealth than before the crash. The pattern from 1720 repeated in 1837. The difference was scale and the institutions involved, not the mechanism. The Panic of 1873 demonstrated the pattern's evolution across international markets. This one started in Europe, but crushed America. The railroad boom had created massive speculation. Railroads borrowed billions to build tracks across the continent. Banks financed the construction. Investors bought railroad bonds, assuming growth would continue forever. It didn't. Stage 1, bubble in railroad financing. Between 1865 and 1873, American railroads laid 33,000 miles of new track. Most of it was financed by debt. Banks underwrote the bonds. Investors bought them. But many railroads had no customers. They built into empty land hoping settlers would come. The revenue never materialized. J. Cook and Company, a major bank, underwrote massive railroad bonds. They promoted these bonds aggressively, sold them to middle-class Americans as safe investments. But internal communications showed executives understood the revenue projections were optimistic at best. Stage 2, position before the crash. In September 1873, Cook's bank declared bankruptcy. It triggered a panic. The stock market crashed. Within months, 89 railroads declared bankruptcy. 5,000 businesses failed. Unemployment hit 14%. The Depression lasted 6 years. But some elites, with access to private information about railroad revenues and European credit markets, repositioned before the cascade. Cornelius Vanderbilt had sold his railroad stocks in early 1873. He converted to cash and gold. When the crash came, he used that cash to buy bankrupt railroads at liquidation prices. J.P. Morgan's father, Junius Morgan, operating from London with direct access to European banking intelligence, began buying distressed American railroad bonds in 1874 at 20 cents on the dollar. He knew they'd eventually pay. By 1879, those bonds were worth face value. The Morgans made millions. The pattern repeated again. Insiders with information. Advantages in credit access create conditions for inflation. They reposition before collapse. Crash happens. Public destroyed. Insiders buy distressed assets and profit from recovery. Each iteration refined the mechanism. The Great Depression, 1929 to 1933, perfected the pattern at industrial scale. The 1920s were a credit boom unprecedented in American history. Stock margin lending allowed people to buy stocks with 10% down and borrow the other 90%. Everyone was investing. Shoeshine boys were giving stock tips. The market tripled between 1924 and 1929, but it was a bubble built on debt, and the structure created perfect asymmetry. Those with inside information about credit conditions and corporate earnings could position before collapse. Those without that access could not. Stage 1. Bubble created through margin lending. Banks lent money for stock purchases, brokerage firms lent money, even corporations lent money. The lending was reckless by any historical standard. People borrowed $8 billion to buy stocks by 1929. That's $140 billion today. When stocks rose, everyone made money. But if stocks fell, borrowers would be forced to sell to repay loans. That would push prices lower, forcing more selling. A cascade was structurally inevitable. Stage 2. Insiders positioned before the crash. Joseph Kennedy, Bernard Baruch, and other elite insiders with access to corporate earnings, data, and banking liquidity information began selling stocks in early 1929. Not all at once. Gradually. They'd built positions during the boom. They sold to the public at peak prices. Kennedy later admitted he knew the market was unsustainable when he heard a shoeshine boy giving stock tips. If everyone's in, liquidity for exit disappears. The Rockefeller family began liquidating stock positions in mid-1929. They moved into cash and gold. Andrew Mellon, Treasury Secretary and one of the richest men in America, with direct access to government financial data, sold stocks and bought art, assets that couldn't crash the same way. In October 1929, the market crashed. Stocks lost 23% in 2 days. Margin calls forced selling. The cascade began. By 1932, stocks had lost 89% of their value. $50 billion in market value gone. That's $860 billion today. But the real devastation was in the banking system. 9,000 banks failed. When your bank fails, your savings are gone. No FDIC insurance existed. People lost everything. Stage 3, buy assets at the bottom. Joseph Kennedy bought real estate, distressed companies, and Hollywood studios during the Depression. His wealth doubled. The Rockefellers bought entire companies at bankruptcy prices. They bought Rockefeller Center land when developers defaulted. They bought stock in companies trading below liquidation value. J.P. Morgan's bank bought failing banks. They consolidated the financial system. By 1935, Morgan controlled more banking assets than before the crash. But something new happened in 1929, something that would define all future collapses. Stage 4. Use government policy to protect elite institutions. In 1933, Roosevelt created the New Deal, programs to revive the economy. But who designed those programs? The same bankers who held concentrated positions before the crash. Roosevelt appointed Joseph Kennedy to head the SEC, the agency created to regulate Wall Street. Kennedy, who'd profited from the crash through advanced positioning, was now writing the rules. J.P. Morgan's partners advised on banking reform. The Banking Act of 1933 was written by bankers. It created rules that benefited large banks and made it harder for small banks to compete. The elites didn't just survive the Depression. They used government power to ensure they'd dominate the recovery. This was the mechanism's critical evolution. Before 1929, elites survived through private positioning. After 1929, they added government protection to the pattern. This changed everything going forward. Jump to 1982. The Latin American debt crisis demonstrated the pattern's application to sovereign lending. During the 1970s, American banks lent hundreds of billions to Latin American governments. Mexico, Brazil, Argentina, they borrowed massively to fund development. The banks, Citibank, Bank of America, Chase Manhattan, lent eagerly. High interest rates, high profits. But the loans were denominated in dollars. When the Federal Reserve under Paul Volcker raised interest rates to 20% in 1979, the cost of servicing dollar debt exploded. Latin American countries couldn't pay. In August 1982, Mexico announced it was defaulting. Brazil and Argentina followed. The banks faced catastrophic losses. If Mexico, Brazil, and Argentina all defaulted, Citibank and Bank of America would be insolvent. Stage 1. Bubble in sovereign lending. The banks had lent more than their capital reserves. Citibank had lent $13 billion to Latin America. Their total capital was $4 billion. If those loans defaulted, Citibank was finished. The same was true for other major banks, but the structure created optionality. The banks held relationships with government officials and central bankers. They had access to emergency facilities. Stage 2. Position using government intervention. The banks approached the Federal Reserve and Treasury. They argued that if they failed, the entire American financial system would collapse. They were too interconnected to allow failure. The government response protected the banks, not directly, through the IMF. The IMF lent Mexico, Brazil, and Argentina enough money to keep making interest payments to American banks. The loans were called structural adjustment loans. But they didn't reduce the debt. They just rolled it over. And the IMF imposed brutal conditions, cut government spending, privatized state assets, open markets to foreign investment, devalue currencies. This devastated Latin American economies. But it protected the banks. They kept collecting interest. Stage 3. Profit from the restructuring. American corporations bought privatized assets at depressed prices, Mexican oil fields, Brazilian telecommunications, Argentine utilities. The banks sold the debt at discounts to hedge funds, taking losses but avoiding total collapse. And the debt never went away. It was restructured, refinanced, extended. Latin America spent the next 2 decades repaying debt that, by traditional banking standards, should have been written down. The bank survived. Latin American citizens paid the cost. Decades of austerity, lost growth, poverty. The pattern evolved further. Insiders created crisis conditions through reckless lending, positioned by using government power to force intervention, profited from restructuring and asset purchases. The public, in this case an entire continent, bore the cost. The mechanism now operated across sovereign borders with explicit government backing. 1. The financial crisis. This is the clearest example of the pattern's full evolution, and it's documented in government reports. Between 2000 and 2007, American banks created a housing bubble through subprime lending. They lent money to people who couldn't repay under standard underwriting. They packaged those loans into securities and sold them as safe investments. Internal emails from banks show executives describing the loans as worthless while continuing to originate them. But they were paid on volume, not quality. And the structure created perfect asymmetry for those with access to loan-level data. Stage 1. Create the bubble through reckless lending. Banks originated $2.5 trillion in subprime mortgages between 2004 and 2007. They falsified income on loan applications. They sold adjustable rate mortgages to people who couldn't afford them when rates reset. And they securitized everything. They packaged the mortgages into CDOs, collateralized debt obligations, and sold them to pension funds, insurance companies, and foreign governments as safe, AAA-rated investments. Rating agencies, paid by the banks, gave AAA ratings to securities that were 80% subprime. The entire structure was designed to move risk from those with information to those without it. Stage 2. Position before the crash. In 2006, Goldman Sachs began shorting the housing market. They created synthetic CDOs designed to fail. They sold these to clients while simultaneously betting against them. Goldman made $4 billion from the crash. John Paulson, hedge fund manager with access to granular mortgage performance data, saw the structural weakness in 2006. He created a fund to short subprime mortgages. His fund made $15 billion when the market collapsed. Paulson personally made $4 billion, the biggest single-year payout in history. Other insiders did the same. They stopped buying mortgage securities. They shorted the housing market. They moved into cash and treasuries, and they said nothing publicly. In September 2008, Lehman Brothers collapsed. The crisis went global. Stock markets crashed. Banks failed. $16 trillion in household wealth was destroyed. 8 million Americans lost their jobs. 10 million lost their homes. But the insiders who'd repositioned using information advantages were protected. Stage 3. Use government intervention to survive and consolidate. The government, led by Treasury Secretary Hank Paulson, former CEO of Goldman Sachs, intervened to protect the institutions. $700 billion through TARP. Trillions more through Federal Reserve programs. The banks that created the crisis, Bank of America, Citigroup, JP Morgan, Goldman Sachs, were preserved. And they used the intervention money to buy failed competitors. JP Morgan bought Bear Stearns for $2 per share, a bank that had been worth $170 per share a year earlier. Bank of America bought Merrill Lynch. Wells Fargo bought Wachovia. The crisis consolidated the banking industry. The too big to fail banks became even bigger, and the executives received bonuses. In 2009, while unemployment was 10% and millions were losing homes, Wall Street paid $145 billion in compensation and bonuses. Lloyd Blankfein, CEO of Goldman Sachs, made $53 million in 2007, the year before the crash. In 2009, after government intervention, he made $47 million. He was compensated for positioning his institution to survive. Stage 4. Profit from the recovery. The Federal Reserve dropped interest rates to zero. They printed $4 trillion through quantitative easing. This money flowed into asset prices, stocks, real estate, bonds. The wealthy, who owned assets, benefited. The middle class, who lost homes and jobs, did not. By 2020, the wealth of American billionaires had doubled from pre-2008 levels. Meanwhile, median household wealth was still below 2007. The pattern repeated with perfect fidelity. Insiders created bubble conditions, positioned before crash using information advantages, used government intervention to survive, profited from recovery, public paid the cost. Now let me show you the complete 6-stage pattern that repeats across every collapse. Stage 1. Create bubble through credit expansion. Every collapse begins with excessive lending relative to productive capacity. South Sea Company lent money for people to buy its stock. 1830s state banks printed unbacked currency. 1870s railroad bonds exceeded railroad revenues. 1920s margin lending. 1970s Latin American loans. 2000s subprime mortgages. The mechanism is always the same. Make credit available beyond sustainable levels, inflate asset prices, create the illusion of wealth, and the insiders control the lending. They're the banks. They're the institutions creating the credit. They hold the data on sustainability. They understand the structural limits. Stage 2. Promote to the public while repositioning privately. While the bubble inflates, insiders promote it publicly. Buy stocks. Real estate never goes down. This is a safe investment. They tell the public to buy. Meanwhile, they're selling, converting bubble assets into safe assets. Gold, foreign currency, land, treasury bonds. This is the critical phase. The public buys at peak prices. The insiders sell at peak prices. When the crash comes, the public owns the worthless assets. The insiders hold cash and safety. This isn't coordination, it's structural position. Those with access to internal data reposition. Those without that access cannot. Stage 3. Crash occurs and distressed assets become available. Sometimes insiders trigger the crash through withdrawal of credit. They stop lending. They call in loans. They short the market. Other times, structural collapse happens when debt service exceeds productive capacity. The crash doesn't require coordination. The structure makes it inevitable. But the crash benefits those positioned in stage 2. It wipes out competitors. It creates buying opportunities at fractions of previous prices. It creates conditions for government intervention that will benefit those too important to fail. Stage 4. Use government power to survive. This is the key evolution since 1929. Before the Great Depression, elites survived through private positioning. After 1929, they added government intervention. When collapse threatens the elite institutions, they approach government with a simple message. We are too interconnected to fail. Our collapse will destroy the system. And governments respond with intervention. Not because politicians are corrupt, though capture exists, because the political system cannot afford systemic collapse. The elites have built institutions so large and so interconnected that their failure would destroy the broader economy. This gives them structural leverage. Protect us or face depression. And governments always choose protection. The incentives permit no other response. Stage 5. Buy assets at distressed prices. During and after the crash, assets are available at massive discounts. Real estate at 50% off. Stocks at 70% discounts. Entire companies in bankruptcy. The insiders, holding cash from stage 2 and backed by government support from stage 4, buy everything. They buy from desperate sellers. They buy from bankruptcy courts. They buy from foreclosure auctions. And they pay cents on the dollar. This isn't predatory, it's rational. Those with capital during crisis buy from those without capital. The structure creates the opportunity. Stage 6. Profit from recovery and consolidate control. When recovery comes, the assets bought at the bottom appreciate. The insiders who bought real estate at $200,000 sell it at $600,000 when the market recovers. The stocks bought at $10 return to $100. The companies bought at bankruptcy prices return to profitability. And the insiders consolidate. They bought their competitors. They bought market share. They now control more of the economy than before the crash. Every crisis concentrates wealth. Every collapse transfers assets from those forced to sell to those able to buy. And every recovery rewards those who survived. Let me show you this pattern with specific numbers from 2008, the most documented collapse. Pre-crash, 2007. The top 1% owned 35% of American wealth. Post-crash, 2009. The top 1% owned 37%. By 2020, the top 1% owned 42%. The crash and recovery transferred 7% of all American wealth upward. That's $7 trillion. $7 trillion moved from the bottom 99% to the top 1% because of how the crisis was structured and managed. The interventions went to institutions owned by the wealthy. The asset purchases went to those with cash. The recovery lifted asset prices, which the wealthy owned disproportionately. Meanwhile, the middle class lost homes, lost jobs, depleted savings. They sold assets at the bottom because they had no choice. They never recovered. This is the mechanism at work. Crisis destroys middle class wealth. Government policy protects elite institutions. Recovery enriches those who survived. In every cycle, the concentration increases. Now let me show you why these conditions exist again, and why, if the pattern continues, the same sequence will repeat. Stage 1 is already complete. Credit expansion beyond sustainable levels. Since 2008, global debt has increased from $180 trillion to $320 trillion. That's a $140 trillion increase. U.S. federal debt is $36 trillion. Corporate debt is $11 trillion. Household debt is $17 trillion. The credit expansion is larger than 2008, larger than 1929. It's the largest in human history. And it's being created by the same institutional structure. The Federal Reserve printed $9 trillion since 2008. That money inflated asset prices. Stocks are at all-time highs despite productivity growth remaining modest. Real estate prices exceed historical norms relative to income. Bonds trade at valuations that assume perpetual low rates. Everything is expensive because credit is abundant. Stage 2 is observable now. Repositioning before potential collapse. The ultra-wealthy are moving capital into safety at historically high rates. In recent years, U.S. billionaires hold over $1 trillion in cash and cash equivalents. That's double the level of several years prior. This isn't spending money, this is positioning. They're waiting. They're preparing to buy assets if and when distressed prices emerge. Central banks globally are buying gold at the highest levels in over 50 years. They're diversifying away from dollar-dominated reserves, preparing for potential currency instability. The wealthy are buying hard assets, farmland, water rights, energy infrastructure, assets that hold value through currency depreciation or systemic stress, and short positions have increased. Hedge funds hold significant short positions on commercial real estate, regional banks, and certain government bonds. They're positioned to profit if those assets decline. The structure is identical to previous cycles. Credit expansion creates bubble conditions. Those with access to institutional data and capital markets reposition into safety. The asymmetry is built into the system. Stage 3, the trigger, could come from multiple structural weaknesses. It could be a debt crisis when interest payments consume all growth. It could be a banking crisis when commercial real estate loans default and regional banks face insolvency. It could be a currency crisis when confidence in reserve currency status erodes. Or it could be geopolitical disruption that contracts trade. The specific trigger doesn't matter. The bubble exists. The structure is fragile. The crash becomes probable when debt service exceeds productive capacity. And if crash occurs, stages 4, 5, and 6 follow from the structure itself. The government will protect the elite institutions. Too big to fail will be invoked because the alternative is systemic collapse. The Fed will intervene with liquidity. The assets will be bought at the bottom by those who positioned in stage 2. And when recovery comes, the wealth concentration will exceed previous levels. This isn't prediction. This is pattern recognition applied to observable structure. The credit expansion exists. The repositioning is observable. The structural fragility is measurable. If the pattern continues, the sequence follows. Here's what you need to understand. This isn't a conspiracy. This is a system, a structural mechanism that financial elites have access to because of their institutional position. 7 major collapses across 3 centuries, 7 times the same pattern. Create credit bubble. Position before crash. Survive through government intervention. Buy at the bottom. Profit from recovery. Consolidate control. The system persists because the elites control the institutions that create credit. They control the banks. They have information advantages because they operate inside the financial system. They have access to capital during crises because they control the institutions with emergency credit lines and government backing. They have political influence because the system cannot function without the institutions they control. The revolving door between Wall Street and Washington isn't corruption. It's structural integration. Treasury secretaries come from banks. Fed officials consult for banks. Regulators join banks after government service. This creates alignment of interest between public policy and elite institutional survival. The system isn't broken. It's working as designed for them. And if the next collapse comes, it will be the most concentrated yet. Because the credit bubble is larger. Because wealth is already more concentrated than any time in a century. Because more assets will be available at distressed prices. Because the structural mechanisms are more developed than ever. So what does this mean for you? First, understand you're not in their system. You don't have access to the information. You don't have access to emergency credit facilities. You can't get bailouts. You can't buy assets at bankruptcy auctions on institutional scale. The system isn't designed for you to survive crashes the way elites do, but you can protect yourself at your scale using the same principles. Hold assets that survive collapse, not just stocks, real assets, gold, silver, productive land, businesses that generate cash flow regardless of credit conditions. These hold value when paper assets collapse. Avoid excessive debt. Debt destroys middle-class wealth during collapse because you're forced to sell assets to repay loans. Elites use debt to buy assets. You're on the other side of that trade. Hold cash or safe liquid assets. When crashes come, liquidity is power. Those with cash buy from desperate sellers. Even modest cash reserves give you options during crisis. Watch the structural indicators. When credit growth exceeds GDP growth for extended periods, bubble conditions exist. When insiders increase cash positions and sell assets, repositioning is occurring. When government discusses systemic risk, intervention is being prepared. Don't trust official narratives during bubble conditions. When elites say everything is stable, they may be repositioning. When they say the system is sound, they may be preparing for instability. Their public statements serve different purposes than their private actions. And most importantly, understand the pattern. Because once you see it everywhere. You'll watch credit expand and recognize the structural fragility. You'll watch insiders reposition and understand what it signals. You'll watch the crash and understand who's positioned to profit. You'll watch the intervention and know which institutions it protects. You'll watch the recovery and see the wealth transfer occur. The financial elites survive every collapse through the same mechanism. They occupy positions that give them information advantages. They position before the crisis, using that information. They use government intervention to protect their institutions because the system cannot function without them. They buy distressed assets while everyone else is forced to sell. They profit from recovery because they own the assets that appreciate. And they emerge with greater concentration than before. 7 collapses over 3 centuries. The same structural pattern every time. South Sea Bubble, Panic of 1837, Panic of 1873, Great Depression, Latin American debt crisis, 2008 financial crisis. And the conditions exist again now. The credit has expanded, the bubble has inflated, the repositioning is observable, the pattern is repeating. If the structure continues, the sequence follows. The public will lose, the elites will survive, and the concentration will increase. Because the system isn't designed to distribute wealth broadly, it's designed to concentrate it at the institutional level. And collapse is the mechanism through which concentration accelerates. The pattern doesn't require conspiracy. It requires only structure, incentives, and information asymmetry. The structure exists, the incentives are clear, the asymmetry is built in. What happens next depends on whether the structural weaknesses trigger collapse or whether intervention extends the cycle. But history suggests that credit bubbles this large don't end peacefully. They end with transfer, from those who must sell to those positioned to buy, from those without access to those with it, from the many to the few. This is the pattern. 7 times across 3 centuries. And the structure that created it exists today, larger and more concentrated than ever before. If you want more breakdowns like this, subscribe. I'm mapping the pattern in every major collapse.